first webinar of 2024, and of course we are already in the third week of 2024, and we have already seen some price action, not necessarily in the traditional market, but we do have a bit of movement across the board. And last night we have new highs in equity markets in the States. So we're going to spend a bit of time to talk about a little bit about what happened last year and what are the main themes that has been driving the market, especially into the last 2 months of 2023. And what are the new themes, if there's going to be any, for 2024, and what those themes will be driving the markets going forward. And we will cover quarter by quarter. We will be, of course, doing this for the first quarter of 2024. So hopefully, before we reach the second quarter, things may have changed a little bit, and we will do another update by then. Okay, now let's get started. Now, we'll talk about the US economy. I'd like to spend a bit of time to talk about the US economy because at the end of the day, the US is still the largest economy in the world, and whatever they do or how they perform will definitely impact the rest of the world. So we're going to spend an in proportionate amount of time to talk about the US economy. And of course, I will be covering certain data sets, and I hope you can bear with me because they are pretty dry. Okay, so but those are necessary because I need to build a background for you so that you know what we are talking about and what to prepare. Okay, first of all, we want to talk about US Treasury yields. Now, US Treasury yields are the reward for buying US Treasuries, and US Treasuries are nothing more than IOUs issued by the US Department of Treasury, which is de facto their finance ministry. Every country will have a finance ministry, but in the US, they don't call it ministry, they call it by departments. Okay, so the department in charge of finance is called the Department of Treasury. Like I said, it is their equivalent of the finance ministry. And for the US governments to be able to function, from time to time, they will raise debt issues, and that is how they borrow from the public and use those proceeds to run their various programs. Now, in any government, we all know the government's income only comes from taxation. So the amount of tax they collect hopefully is enough to pay for all the things that they want to do, whether it is to run public school or where to run public transport or for the military or for the social welfare. Everything comes from taxation, right? So if there's a shortfall in taxation, the difference is usually made up by the issuing of treasuries, or what we call the government bonds. Okay, so in the US, government bonds are called treasuries, and treasuries have different duration. There are those that are as short as 30 days. Those are called treasury bills. Anything that the government issued that expires within the year is called bills. Okay, anything that that goes beyond 10 years to 20 years, those are called notes. Okay, so we have treasury bills, treasury notes, and of course those are there's another category called the treasury bonds, and those are the ones that are longer dated, maybe as long as 30 years bond. Okay, so each duration of bonds have different coupon rate. Now, the coupon rate is actually the yield you will get for buying these bonds. Okay, so the usual the bellwether yields in which most investors will look at is the 10 years treasury yields, because it's not too short, it's not too long, it's just about right. So the 10 years usually is a bellwether treasuries, and the amount of yields that one can have is a reflection of the risk involved. The higher the coupon rate, the yield, the higher the risk, because as you say, government when they borrow money, especially the US government, because of the AAA ratings, because they are good for their money, so therefore they do not have to pay premium. However, we have seen that changes. For the last 18 months, we can see US interest rate has been going higher and higher and higher, and it hit a peak at 5.5% where it stands currently. Okay, and we can see that that has been a result of quantitative tightening and an activity in which the government is trying to draw liquidity from the marketplace. And of course, we also knew that that is still ongoing, and later on I'll talk a little bit about that because it will also impact what's going to happen this year. So you can see that the yield on the 10 years US Treasury went up to as high as 5% in October of last year, and that has steadily been coming down. But of late, since the beginning of this year, we can see the yield on the 10 years has been climbing again. And last, it was traded at 4.175%. So we can see that for the US government to pay 4% when they usually pay something like 0 point something odd percent. So we can see that this is quite a premium, okay? So this means that in order to attract people to buy the US treasuries for the 10 years, for example, the US treasury would have to pay an interest rate of 4.175 as of last night. So we can see this is the amount. So what is the significance of this? The higher the yield means the US government cannot find buyer, okay? And of course, we know the pressure right now on the US Department of Treasury is that foreign buyers are no longer buying, or I should say they have been slowly reducing their holdings of US treasuries since 2008. Okay, so we can see this is a long time coming. And of course, over the last few years, the biggest buyer, which is China, has been steadily been reducing their holding. Now they are only behind Japan. They are no longer the biggest buyer of US treasuries, and they have fallen behind. And they have been steadily been reducing their holdings by almost 50%. So we can say that this is a trend. Why are foreign buyers no longer buying? Because the US is on a what you call that? It's on a binge whereby they have been borrowing to finance their operation, so much so that it does appear that this is unsustainable. So in order to compensate for the risk, they will have to pay higher risk. Higher yield. So this is where we are right now. So the yield on the 10 years is at the highest in over a month. Okay, you can see this is very strong. And of course, recently we have this month we have the release of retail sales, and retail sales suggest that the economy is doing very well. So that means that the talk about the Federal Reserve, which is the central bank of the United States, talking about them cutting interest rate may not happen immediately. Now, this is important because the whole narrative of the US stock market rising, especially in the last 2 months of 2023, has been nothing but rate cuts. All this talk about rate cut, and the market is betting against the Federal Reserve, thinking that they have got it wrong and they have to cut interest rate very, very sharply. Now, before this week, retail sales number, we can see that the market was expecting 7 rate cuts in 2024. Although at the end of the last FOMC in which the Federal Reserve held the meeting, they actually hinted at 3 cuts in 2024, and they say it's going to be in the later half, okay, not immediately. So rates is going to stay stable for now, all the way until the data set changes. Right now, the data set has been so strong. We have CPI numbers, which is the inflation number, been climbing. So that means to say that the fight against inflation is not over yet, and therefore the Federal Reserve is highly unlikely to cut rates in the face of resurging in inflation. So this is the background in which we are looking at, and then coupled with this, retail sales is expanded very, very strong. The market was expecting 0.4%. It came in 0.6, which is 50% more than the market expected. So this is all suggesting the economy is doing well. The labor market is resilient, and inflation appears to be coming back. And these are not conditions in which the Federal Reserve wants to see before they starts to cut rate. Now, the first FOMC meeting for this year is scheduled for the end of this month and the beginning of February. So it's usually a 2-day affair. So on the second day of the meeting, then they will decide, or rather they will announce, okay, what is their decision. So watch out from February the 1st. That will be the first FOMC interest rate decision meeting. Okay, so based on this chart here, it seems that US Treasuries appears to be coming back up in terms of the yield. That means to say, will the yield stays high going into 2024? Now, what impact does it have? So far, it has no major significant impact, because during the period when the yield was climbing, it did not cause a stock market to come down significantly. Okay, so we can see that higher yields so far has not negatively impact equity markets. But if this yield continue to climb, which I think it may in the years ahead, then obviously that will be a negative for equity markets. You need to know the relationship between US Treasury yields and equity markets, because both are representing 2 different things. Equity markets represent risky assets. Basically, if you are in a mood to take risk, most people will put their money in equity markets and buy stocks. And if people are no longer confident or they have doubts about the immediate future of the economy, they will want to go risk off. That means to say they rather hold on to government bonds and not into equity, into risky assets such as equity markets. So knowing which way the yield is going to go will give us an idea where and when to get out of stock markets. So for a time being, yields does not seem to have a negative impact on equity market just yet. Maybe the yield need to go a lot higher to negatively impact equity markets. Okay, so the other thing that we want to talk about, why is it that the yield is so high, is because the US government needs to borrow, and they need to borrow heavily. Now, this week, we have the latest news is that US national debt has already crossed $34 trillion. Now, if you have no idea what is a trillion is 12 zero, and this is massive. Okay, now the last time we checked previously, for the US government to accumulate $1 trillion in debt, it took them about 12 years on average. But we can see that the last time the US national debt was at $33 trillion, that was only 3 months ago. So in just 3 months, they managed to accumulate $1 trillion in debt. And by the end of March this year, this number is likely to go to $35 trillion. So the rate in which the US government has been borrowing is a little bit scary, because it does not seem to be able to stop this runaway train, right? So the more they need to borrow, and when they borrow, they will have to do so by issuing more government bonds. And in order to attract buyers, they will have to offer higher yields. That's why I'm saying, unless the trajectory for the national debt in the US comes down, okay, or is reduced dramatically, the yield on US treasuries cannot come down, because you will have to always pay more, okay, to attract buyers. And we can see foreign buyers are no longer buying. Even their traditional allies like the UK and Canada, Australia, they have been reducing their holdings in US treasuries. So that is also a symptom of the problem that the US fiscal policy is heading. Okay, so it's all bad. Okay, so this right now, the interest to service this mountain of debt is getting close to almost $900 billion. So this is very, very troublesome. Okay, so this will be one of the key issues to watch out, because this is a ticking time bomb. Eventually, all countries will have to face the Waterloo, because all national debts are very, very high right now, especially those foreign countries that borrow in US dollars. Okay, and we all know, if the US interest rate stays high and the dollar stays strong, the amount of the debt will actually explode, because there is a foreign exchange risk here. If you are Malaysian, for example, and your if Malaysia borrows a lot of issue a lot of debts or borrow a lot of debts in US dollars, definitely the ringgit is coming down. And when you calculate in ringgit term, you will understand that why this national debt eventually will become a problem. And I'm not saying that Malaysia has a very unique problem. It is it is universal among the emerging markets. So that the next crisis could come from emerging markets. Okay, those emerging markets that have borrowed heavily in US dollars now would have to contend with not only a reduction in their currency value, they also see in dollar term their national debt has actually balloon. Okay, so at some point something bad may happen. Okay, so we are now looking at the US situation. This trajectory that we are seeing does look very, very hairy. It does not look like it's going to go it's going to come down anytime soon. In fact, they were saying that by the year 2030, this number is going to go to $50 trillion. So is it even sustainable? So that you can ask yourself, at some point this bubble is going to burst. Okay, so just don't be around in equity markets when this bubble finally bursts. Okay. So the Federal Reserve balance sheet, now this is another time bomb. Okay. So during the pandemic, we knew that the US government has been launching a lot of stimulus package. Remember when Biden came into power, the first thing that he did was actually to sign into law sending money into everybody's letterbox. Okay, basically he will sign checks and deposit them into every household. Okay, and all this money comes from the Federal Reserve. The Federal Reserve would have to create the money so that the government can actually send it out to support consumption, because during that time there was lockdown and everybody are asked to stay home. You cannot go to the office, you cannot go to work, you cannot do your business. So basically, in order for the economy not to tank, they must still maintain consumption within the economy. And one of the way to do it is to give away what we call helicopter money, right? So this money has come from somewhere, and the Federal Reserve create the condition for all this money to be had. And you can see there was a period of time, you can see the market actually ballooned, right? So this is a very, very steep climb in terms of their reserve, because all this will goes into the Federal Reserve balance sheet. At the highest point, we can see the amount of balance sheet in the Federal Reserve books stands at just under $9 trillion. This is the most we have ever seen in the Federal Reserve balance sheet. And they have been trying to reduce this by not rolling over, they allow it to expire. And this is a combination of holdings of US Treasury, as well as what we call MBS, which is called mortgage-backed securities. Now, if you do not know what's mortgage-backed securities, go back and check the internet, go and Google MBS, mortgage-backed securities. This is the one thing that actually blew up the US housing market back in 2007. Okay, so the Federal Reserve has a lot of all these toxic items in their balance sheet, and they've been trying to get rid of them. To some extent, they did manage to bring it down. You can see that the latest number that we had reported by the Federal Reserve is $7.67 trillion. So they managed to bring down almost $1.3 trillion during the period from the peak of almost $9 trillion in April of 2022. So we can see that over the last less than 22 months, they have managed to bring it up. Although there was a bit of a blip here, you can see there's a move here, a blip here, when the balance sheet actually go back up again, and that was during the last March banking crisis, when the Silicon Valley Bank actually collapsed. Okay, we knew that in March of last year, many banks actually collapsed. Of course, the most famous one is Credit Suisse, right? Credit Suisse also went kaput during that period of time. So the Federal Reserve came up with what I call a stopgap solution by offering a short-term lending facility to the bank, allowing them to borrow against their holdings of US Treasury. I will also talk about it later, because this is also another key item, which I also think is going to be very, very crucial in knowing when the US Federal will actually cut rates. Okay, so we can see this is something that they will have to do. But of late, during the last FOMC meeting, the minutes of the meeting shows that the Federal Reserve are talking about stopping this. Okay, they are going to stop doing quantitative tightening. Okay, meaning to say, because right now, the Federal Reserve is beside foreign buyers, okay, of US Treasury, the Federal Reserve is the single largest buyer of all the issues. I mean, we talk about fresh issues and not secondary market, the fresh issues issued by the US Treasury, to the tune of maybe they are commanding about 35% of all that is going on. Okay, so if the market cannot buy or does not want to buy, the Federal Reserve usually with a buyer of last resort. But because they are doing quantitative tightening since April of 2022, they have not been buying. Okay, so who is buying right now? So the buying have to be done by Americans. Americans means pension funds are buying. Now, pension funds has bought a lot of US Treasuries, especially those during the pandemic, where the yield was close to zero. And when interest rate goes to 5.5%, all these holdings that they have bought previously, they all lose money, and they are losing a lot of money. Okay, so now the pension funds are basically broke. Okay, so and the people buying these new issues of US Treasuries are Americans, either individuals or pension funds. Okay, so the pension funds is basically running on empty, especially those big one in California. You can see that they have bought so much of all these toxic assets from the Treasury, which used to be called very, very secure investments. Okay, but right now we can see, because of the interest rate movements, all these holdings are already upside down. Okay, so this will be another issue that we have to cover, because it will be a flashpoint at some point in time. Okay, so this is where we are right now. If the Federal Reserve starts to end quantitative tightening, because right now there is an issue with liquidity. There's hardly any liquidity moving inside the US financial system. Now, liquidity means what? Every single day, at the end of every business day, all the banks and financial institutions, including brokers, would have to maintain a certain amount of reserve, okay? And this is by law. So for those who do not meet the necessary criteria, they will have to borrow from their peers. That means it goes to say that they go to bank A may go to bank B and say, I want to borrow X amount, okay, and I will give you my holdings of liquid assets. And usually this comprise of treasury bills. And then say, okay, I want to borrow for 24 hours. I just want to tie for until the next day. Okay. So these are very short-term things that goes on behind the scene. It is like the plumbing in the system itself. So when the market has very little liquidity because the Fed is doing quantitative tightening, so if the other bank don't want to lend, they will have to pay even higher interest rates, even for 24 hours. So right now we have this issue right now whereby the market is short of credit. Okay, if the banks are short of credit, they are not able to make loans, and if they cannot make loans, it will eventually impact their bottom line. This week we have seen banks reporting their earnings, and some of the numbers are pretty ugly. Okay, so we can see that the banks are not doing well. Okay, and if you need to know how bad banks are not doing well, just look at India. Okay, this week we have seen the Indian stock market practically crash because the bank shares are off meltdown. Okay, so and it is not just India. I think everywhere else, if you borrow, because when we talk about US interest rate, it does not just concern US financial institutions. It's worldwide because everybody borrows from everybody, right? And the biggest source of liquidity appears to be the States, and it will have knock-on effect. So we can see this week itself, we can see China equity went down, Hong Kong equity went down, Tokyo actually went down before it bounced, and we can see Taiwan is down. So everywhere in Asia, stock markets are basically coming down, and this all have a direct lineage all the way to the Federal Reserve. So look out for all these movements as you are trading, okay? So in the first Friday of this month, we have the latest number for the non-farm payroll, which is a labor number. Okay, so everybody will be watching this big number because the US labor market is a big market where people will take a measurement of their performance and decide whether the US consumer is strong enough to consume. Because at the end of the day, the US consumer is US economy is a consumerism economy. So if Americans do not spend, then the GDP will go down. Okay, so and if you backtrack, the source of all this ability to spend is always on jobs. If you got jobs, you will be able to spend. If you are out of a job, obviously you're going to tighten your belt, you're going to prioritize your spending, and that will impact the overall consumption pattern within the economy. So the latest number came in has been 216,000. This is very, very good because the market was expecting 170,000 jobs being created. So we can see that for 216, this is actually above average. You can see that on the average, if you can maintain about 200,000 jobs being created every single month, that is healthy. But leading into December, we can see that the last 2 months before December, in October, the number of jobs created was only 105,000, which is bad. And then 173,000 for the month of November, which is a markdown from the last level of 199,000 jobs. So there is a pattern in the non-farm payroll. Now, in the non-farm payroll, there are 3 readings. We have the initial report, okay, that come out on the first Friday of every calendar month. That is the first reading. These numbers are subject to revision, but for all intent and purposes, traders do not pay a lot of attention to the revision, and the revision is quietly been snuck in. Okay, and we have seen the pattern. They report high numbers, and subsequent month, the following month, they will reduce the number. For example, in November, the number was 199,000, and then they revised it down to 173,000. And this is a pattern every single month for the year of 2023. They have been doing that. Okay, so this is a very stealthy way of actually not telling the truth. Okay, but eventually when they report the revision, they corrected themselves, but most people are not watching those numbers. So again, the 216,000 jobs is most likely is going to be revised come the first Friday of February, because again, has been a trend, right? So when we break down the jobs, the quality of the jobs. Now, if you are working in McDonald's, it's considered a job. If you're working in Boeing, that's considered a job. Obviously, when you compare a job, if you're working for Boeing and working for McDonald's as a service staff, the quality of the job is different, okay? Meaning to say, how durable are they, and how long can you work in McDonald's? Usually, those temp jobs, especially falling into the holidays, because we all knew that these numbers are all coming in, leading to the December year-end holiday. We have Christmas, we have New Year, and all those requires a lot of temporary stuff, especially in departmental stores, right? And those are the job creation. However, those jobs being created because of their temporary nature they are not durable compared to those in the manufacturing. So we can see there is another chart on the right here. I actually broke it down for you, and we can see that transportation and warehousing actually saw a reduction, okay, in employment. Okay, we can see the other sector, the construction, those are good because those are more durable. Social assistance and healthcare and leisure and hospitality. But the surprise here is the one at the very bottom. Okay, most of the jobs were created by governments. Okay, that means that those jobs are those working for the federal government or the state government. Okay, so meaning to say they do not produce any economic value. If you work for the government, you only draw a salary, but you do not contribute anything to the total economic pie, so to say. So the fact is that the government has been employing more and more people, and if the US government gets bigger and bigger and bigger, it means that their government spending gets bigger and bigger and bigger, okay? And this is not a good sign, okay? Elsewhere, we want to have a very lean, some kind of civil service forces, okay? But if the civil service gets too big, okay, it becomes a burden, okay? Because of the nature of their economic output, they don't contribute anything to the economy. So those are not good quality jobs, okay? Although it just keep people basically alive just by giving them a job, but somebody had to pay them, right? So how do you pay them? You borrow. When you have to borrow to pay your staff, this is not a good thing, okay? Imagine you're running a company and you are surviving on credit cards to pay your workers. That is of course not sustainable over the long time, okay, over the long period of time. So the quality of the jobs, if you look down into the breakdown, is not a healthy number. So the question here is, people react to the headline numbers, 216,000, which is more than what 40,000 above the market estimates. So the market went wild. Okay, but this means that if the economy, the labor market is strong, that means they will be able to spend because more people get employed. That means to say they are able to go out and spend. And when you have more people employed and able to spend, obviously it's a wrong time to cut interest rates. You will want to only cut interest rates when this number goes into the reverse gear. Okay, if the number of new jobs created are lower over a period of time, that means to say that people are losing jobs, they are hanging on for their jobs for dear life, they're going to be very, very cautious about how they spend, and this eventually will bring down inflation, and that's when you cut interest rates. That will be the, what you call that, the playbook, okay? So when we look at the unemployment rate, now the unemployment rate came in as constant at 3.7% for the month of December, very similar to the month in November. Now this is a climb down from October of 3.9, which was the highest recorded in 2023. So in order for the Federal Reserve to cut rates, it must stay up northward of 3.9%. Okay, meaning to say that the higher the unemployment rate, the more reason the Federal Reserve will cut rates, because obviously when you cut rate, it means that the economy is slowing down. In order not to have a crash or to go into a recession, you want to make sure that you provide an environment whereby interest rates will be allowed, the cost of money can come down. So unless the unemployment rate started to rise beyond 3.9% in this year, okay, and stay up there, then it is a condition or the ingredient needed for the Federal Reserve to cut rates. So be very aware of the relationship between labor numbers and of course when the Federal Reserve may actually cut. Okay, the total by sector does not equal to December. Of course not. This is the breakdown. Of course, there are other minor sectors which are not covered. Okay, Ted, I understand where you're coming from. The number I show you are the major component, not everything. Okay, so I hope that this is can be a clarification here. Now, the other thing, of course, is the average hourly earnings. How much Americans are making on the average? Do we see an increase in their earnings? Of course, if they see an increase in earning, means that they have more spending powers. Now, these earnings are not indexed against inflation. Okay, so although we see a rise of 4.1% for the month of December, but if you take into consideration inflation rate, does the American, are they better off? Okay, so that is the main question. We can see in this chart here, the average hourly earnings has been steadily been coming down since February of last year, and this is a indication that the U.S. consumers are not strong in spending. Okay, so that means to say that if they have a job, but the job is not paying as well as compared to, let's say, 2022 or 2021, that means to say their standard of living may actually be dropping. Okay, and that will have an impact. So like I said earlier on, if the US consumer cannot spend for whatever reason, or they have become very cautious in the spending pattern, it suggests that the US economy will shrink, and we are talking about soft landing. Now, the question about a soft landing, it is a myth, because over the last 110 years of US history, there hasn't been a soft landing. Okay, so to talk about soft landing now, whether the Federal Reserve is so skillful in navigating a very difficult environment to actually allow the economy to slow down and not crash, okay, it is based on historical data. It has never happened. Okay, so all these soft landing talks is basically something that somebody invented, but whether it can actually comes about in that manner, from historical data, we don't see that. Okay, so forget about soft landing. If we ever going to get some kind of slowdown in the economy, okay, we are going to get a very hard landing. Okay, so hard landing means a recession, basically. Okay, so I know there's a couple of questions. I want to address that as we go. Okay, so yeah, it's the same question that Ted has actually typed, so I get it. Okay, so we can say that US consumers are not better off. Huh? Now, the other thing is consumer price index. Now, this is the usual barometer of inflation. Whenever you talk about inflation, people always refer to the consumer price index, or the CPI. So there are two set of numbers. One is on a month-on-month basis, and the other one is year-on-year basis. Means to say that now we are in January. The number that we will be interested will be December of 2023 versus December of 2022. So that will be year over year, and month over month is very simple, right? If this is December and the number is released, we want to compare it against the previous month. So this is a year over year number. We can see that regardless whether we are looking at a core or the headline numbers, of course, the core refers to items that you take away, you take out of this calculation here. Okay, so in this manner, we can see that the core is represented by the blue color line. Okay, and it is at 3.9%, and the trajectory suggests that it's coming down. So this is all good news, right? But 3.9% is nowhere near the target rate of 2%. So we are at least 100% away from the target. Okay, and then on the CPI, which is the headline numbers, we can see that when we take away food and energy component, which is what the core number is all about, we can see the inflation is actually bouncing back. So this is a concern, and this will be stopping the Federal Reserve on its track if they decide to cut interest rate when they go into the first FOMC meeting at the end of this month. They are unlikely to cut interest rate based on this number alone. So CPI suggests, the headline number suggests that we are seeing a resurgence of inflation, at least from the data set that we see. Okay, so if the following month, for the month of December, this number goes up again, okay, then we know that this inflation is here to stay, and we have to push back the talk about rate cut to the next following FOMC meeting, which will not happen until March of this year. Okay, so February we're not going to have FOMC meeting. So every year we have 8 meetings in which the Federal Reserve will decide whether to hike, to hold, or to cut interest rates. Okay, so we have to watch out for those numbers. Okay, the date the first FOMC is almost a non-event, because by looking at the data set, it is highly unlikely the Federal Reserve will want to do anything based on the resurgence of the headline CPI numbers. Again, the breakdown, generally speaking, is into this area here. Most of the inflation are captured in the services, okay? Services and housing, which is what we call shelter, has been eating up a lot of all this expenditure, okay? Services like what? Okay, you send your clothing for laundry services, you pay for utility, for example. Those are services, and those are the one that has been eating up a larger proportion of their income, okay? And the other one, of course, is shelter. We also know that during the pandemic, there was this housing shortage, because the big boys institutions has moved into this area here and started to buy wholesale from developer, to the point whereby people now cannot afford. And right now, the mortgage rate in the States is at 8% and more. So at 8%, you definitely will find it very difficult to service your mortgage loans, right? So people are not buying, okay? And people are not selling because there is a shortage in the marketplace, okay? So right now, people have to rent. And when they rent, you can see that the prices are very, very steep, okay? And right now, we are beginning to see builders building furiously to cover the shortfall. But unless inflation comes down, unless mortgage rates comes down, who's going to buy? That is a big question here. The institution has been buying, people like BlackRock has been buying the entire development even before they are being built, okay? And they are gunning for the single families units, meaning to say that those are the units that people mostly will want to use for their own occupation, okay? Not the families unit. Those bigger units are not so much affected, but it's this a single family unit. Those are the one that American needs. Without a home, without a shelter over the head, they are unlikely to start a family, and if they start a family, they will need assistance. So all these are becoming a problem, okay? Food is not so much a problem right now. You can see that the one that actually went negative is energy. And we have seen the whole of last year, after the initial rush in energy prices, it has been basically been one track, which is basically down. So they have managed to bring down the cost of energy. Gasoline prices has come down because, you know, America is a big country, like very much like Malaysia. Usually you want to get from one town to another town, or one state to another state, you drive, okay? And when you drive, you definitely have to put gasoline into your car, right? So they have not gone very big into EVs yet. So gasoline is still the major product they have to, because they also use gasoline to heat their houses. And we know this month there are a lot of reports that the whole of Northern America, including Canada, they are all having a cold snap. Okay, so bad. I saw a picture of Chicago, which is during this time of the year, the river doesn't freeze. But this year we can see that the river actually have ice, okay, in the river. So it's getting very, very cold. And when it's getting cold, the demand for heating oil will go up, because you need heat, okay? You need heating in your home when it's winter, right? And this year is a little bit more severe. And we are talking about further south in Texas, whereby it is also a major oil producing state. They may actually go into a shortage, okay? Because the facilities are not well maintained, and if they have brownouts and they have blackouts, and that will further impact the GDP going forward, okay? So we are seeing all this, and US is not alone. We have seen how this year has been colder than normal, okay? I have read reports that even Genting has snow, okay? So this is a reflection of the changing weather pattern, okay? In China, it was below 40 degrees Celsius, which is crazy, right? So even in places in the south, like Guangdong, is freezing. So this is the change in weather, which will demand higher consumption of energy. So overall, we probably will see energy prices go back up again, okay? Right, and this is the delinquency rate. Now, this is troublesome because this number suggests that the US consumer right now is caught between a rock and a cliff, okay? Meaning to say, they have been using their credit cards to survive, and more people are not able to pay back their loans. Interest rate has gone up, so everything that you borrow has, of course, going to cost more. So the cost of borrowing has actually gone up, And unless they start to cut interest rate to bring down these rates, I think US consumers will be decimated. The middle class will be wiped out. Okay, so we can see this is a scenario going back all the way to 2021, and last year it has actually escalated. Okay, from 1.66 or 1.57, it has basically doubled. Okay, so we can see that the US consumer either behind on their payments, whether it is utility, whether it's credit cards, payment, they've all been behind, okay? And at some point, this will also mean higher bankruptcy rate. So this is all bad, okay? Consumer loans, you can see that in terms of consumer loan, whether you borrow, you use some kind of credit facility to buy your fridge or your television set, now you can't pay back. So you can see these are also under consumer loans. The other one, the one in blue, those are credit card loans. Okay, this is bad. However you slice it, is all look bad, and this is not even current. The data that I have goes back only to July of last year. Okay, so we don't have the latest number. Over the last 6 months, this number could have gone above 3% for credit card delinquency, and definitely above 2.5 for the consumer loans. So this is bad, and this is not just consumers. Corporations are dying off like flies. The bankruptcy rate at a corporate level is also very, very high. So these are taking away the dynamics of the US economy. Okay, one, you have consumers not able to spend, and then companies are falling behind and declaring bankrupt because they can't survive in a very high interest rate environment. So this will lead to a hard landing. Okay, so I personally think, okay, that a hard landing may be very evident by the second quarter of this year. Okay, now this is another measurement of inflation. We have, on the one hand, look at the consumer perspective, and the other hand, we also look at the input cost, the producer price index. Of course, when a producer wants to go into production, he will need a lot of input, okay, and they all cost money, whether it's energy inputs or whether it's raw material, whether it's labor. This will go into the computation of the producer price index, or what we call PPI. Okay, so here again we have two sets of numbers. We have the blue one, which is a core PPI. We take away, we take out the main component that actually considered to be volatile. Typically is food and energy, and the other one is of course the core number. The core number is not bad. Okay, you can see that the both gradients are going down. Okay, but in the core PPI, you can see that the market has bounced off, although it's very, very shallow, but it is still a bounce off. So meaning to say, when you compare this together with the CPI numbers, it does suggest that prices may actually go up, because at some point in time, the producer will have to pass on the higher cost to the consumers, and the consumer will have to bear the brunt of higher prices. Of course, one way to look at it is the PPI has been coming down. Either that, or either the input cost has gone down, or they have ordered less. So it is a chicken and egg, right? When you think that your customers are not able to buy or order more, then you will order less to produce whatever you are selling. Okay, so basically that is logical. So that this number here does not show the intricacy of why this number has been falling. Okay, it could be due to weak demand, or it could be due to really raw material has come down, in terms of input cost has come down. So here the PPI is not able to give us the breakdown. Okay, so you want to do a little bit of study to look into the breakdown of this number here to see what is actually causing these prices to come down. Okay, whether it is prices coming down from overseas, whether it's due to lower energy prices or lower staff salary, all this will be taken into consideration. Okay. So here is the conclusion that I make. The inflation number that we saw and the wage growth numbers can be misleading because they don't take into account inflation. Okay, because if the workers have to pay more in terms of keeping his family safe and able to provide, okay, obviously he has other costs. He has rental costs, he has electrical bills that he had to pay, he has you have housing costs, and he has also credit card loans that he had to pay. All these will mean whether he can spend or not. Okay, and these numbers here do not take into consideration this. And don't forget, the student loan debacle is coming back to bite Biden in the backside. Okay, because he was actually wanting to forgive all this student loan, but a judge and the Supreme Court said this is illegal. You cannot unilaterally forgive the loans, because at the end of the day, you are moving the cheese away from the bank. The bankers want to be paid. So if you forgive, who's gonna pay the banker? The banker obviously is going to cry foul, right? And the bankers has a lot of influence. Okay, so they are basically telling Biden, you cannot forgive this loan. This loan now had to be serviced all over again. Okay, so they add on to the overall cost. Again, we want to reflect back on the retail sales. The retail sales of late, you can see that earlier on I did mention that this week we have retail sales numbers, and it came in stronger than expected. The market was expecting 0.4%. It came in 0.6, which is 50% more than what the market expected. Previous month it was 0.3, and we can see the month before that in October it was negative. So we can see retail sales is strong over the last 3 months, right? It has actually bumped up. And of course, that can be attributed to the holiday season. People buy more. That is logical. Okay, every year about this time of the year, Thanksgiving, whether it is Christmas, whether it is New Year Day, people tend to spend more, and that bump up retail sales. And this, like I say, is showing us that U.S. consumers are still able to spend, but we also saw the delinquency rate has been climbing. At some point, this spending will stall. And when it stalls, it's just when the Federal Reserve will have to reverse its policy and start to cut rates. I've always maintained that when the Federal Reserve or central banks cut rate, it all depends on how many cuts they take. Okay, because the world has witnessed 19 months of unrelentless hiking of interest rates. For the central bank to do an about turn, okay, it may damage their credibility. Either they have overshoot by hiking too aggressively, too fast, too soon, or now they have to correct that movement by cutting interest rate. When you cut interest rate, the next time you raise interest rate, the market will ignore you. So it will be less effective as a tool. Okay. So if the Federal Reserve cut only 1 or 2 rounds, each time no more than a quarter point, then the market will take it as good news. But if the market has already priced in 6 interest rate cut in 2024, and if the Federal Reserve actually cuts 6 times, that is bad news. And from being positive, it becomes a negative. When you can see Federal Reserve cut 6 times in a row, okay, you want to sell, you want to get out of equity markets, because that means the US economy is definitely in recession. Okay, like I said, I suspect it will be happening in the second quarter of this year. So do watch out for the current bullishness in equity markets. This is creating a narrative to suck in the retail traders. Okay, so be very careful chasing this market ever higher. Okay, short term is fine, but let's say if you're going to have some idea that you want to hold, thinking that this is a brand new bull market. This morning I read the Wall Street Journal, and they have been saying that this is a brand new bull market. We are in a new bull market. I think that is a very dangerous way of reporting. Okay, because when you look into the data, it is simply not supportive of this narrative. Okay, GDP. US has a blown up GDP in Q3. Q3 of last year has been a stellar, because when the first estimate came in, it was 5.2%. Okay, and that was unbelievable, because you can see that on the average, on a quarter-on-quarter basis, it has never moved beyond 3%. Then all of a sudden in the Q3, it has a doubling of GDP, okay, to above 5%. This is of course good news. Okay, so again they revised it 3rd time. By the time the last time they make it official is 4.9%. Now 4.9% is a very, very good number. Now remember, US is a very mature economy. Mature economies do not have this kind of growth. Okay, so going into Q4, the estimates has been drastically brought down to 1.8%. Now, this is even lower than all the quarters before the 4.9 jump. Okay, so 1.8 is the estimates, and we will know this by next week. Okay, so if Q4 is 1.8, you will bring down the average of the yearly growth in the US economy. So something is funny about this number. I always look at this number. I think this is a little bit ridiculous. But anyway, this is an official number. We have to go with whatever number we are given. And now that we know the estimates for Q4 is going to be drastically revised downwards to 1.8, which is even lower than the whole of 2023. okay, on a quarter-on-quarter basis. This suggests that something else, they have to revise it to reflect a more, what you call it, down-to-earth numbers. So this is where we are right now, okay? It means that consumers are not spending as great. Okay, so this is a sign of slowdown. So if we go into the first quarter of this year, which we will only know in April of this year, then that number will be very interesting to watch. Is it going to be closer to 4.9 or closer to 1.8? Okay, that will be Q1 of 2024, and that will only be known in April of this year. We will have to wait for the number. But the next number coming up for Q4 will be next week. So watch out for this one. This is going to be something that the market is going to take not too kindly to, okay? Now, we also have, as a measurement of the US overall economy, other than looking at it from the consumer perspective, okay, we also want to look at it from the production perspective. Purchasing Managers Index is an index that actually measures how much the purchasing managers actually buys in expectation, or whether slower or weaker growth or stronger growth, okay? If they have order books, they are piling up, obviously they have to go into production, okay? That means they will order more stuff. And if the cost of that input goes up, it is not, it's a reflection of the demand or the lack of demand, okay? So basically this is an important number. Now, we all know that this number has two components. One, we have manufacturing, and the other one is services. Now, the one in green is the manufacturing. Now, the manufacturing has been in negative territory. This is a contraction zone. Anything below the 50 mark, okay, which is the contraction zone. The US manufacturing sector has been in contraction zone for the whole of 2023 and a bit more, okay? It has started to dip into the below 50 in October of 2022. So whole of last year, it has been contracting. Although we do see a bit of a bounce, okay? And the last number that we had in December was 47.4. It is an improvement, but it's still in contraction zone. So for it to be getting out of contraction, it needs to be above 50. And it doesn't look like it's going to happen anytime soon. Now, the other one that is more important than manufacturing, because we all knew other than commercial aircraft and perhaps the military complex producing all these weapons of war, okay? The US manufacturing has been in a doldrum, okay? So it is not highly featured because they have basically outsourced that long time ago, okay? They have offshore it long time ago, okay? So they are not producing enough domestically. However, the US has turned their economy into a service-based economy, more financialization of the economy. So the services sector is actually more important as a measurement. So we can see that services sector is also coming down. The last number is barely holding above the 50 mark here. If it goes under, which it did, okay, very briefly in May of last year, then this is also showing the services sector is also in trouble. And if the services sector goes down, okay, into contraction zone, the US GDP will be affected. You can see that this is a pie chart over here. In terms of services, you can see how big this sector is. It represents 87.55% of the US economy. So if the services sector goes down, that is going to be more catastrophic compared to the manufacturing sector here. Because after all, the manufacturing sector only accounts for less than 12.5% of the total output for the US economy. So look out for the services sector. If it continues to dip and if it goes below 50, it is the sign that a recession is definitely on the horizon, okay? So despite all this talk about soft landing, look at the number. The number is more reliable than all these talks by analysts, okay? So this is a reflection of the equity market. This is up to the end of last year. So you can see that there was a major run-up in prices at the end of October. And for 2 months, the market went up by 16%. In these 2 months, the market basically account for the entire growth of 2023, okay? And this is totally unexpected because the only thing that supported this rally in stock market, as far as the Dow Jones is concerned, is all this talk about rate cuts, okay? That means Wall Street is betting against the Federal Reserve, thinking the Federal Reserve will have no choice. They had got it wrong so badly, they will have to reverse course. And the assumption is that rate cut is a positive for equity markets. Again, you have to understand, if the rate cut is only 1 or 2 times, that is fine. That will be actually very conducive for equity market. But if we get 6, 7 cuts in a year, that is all bad. I mean to say that the central banks do not cut interest rates unless they want to what you call it, resuscitate the economy. And we look at the Q3 GDP numbers, 4.9%. There is no need to resuscitate the economy. The economy is doing very well by itself, if you can believe the number, right? So why is there this talk about it, rate cut 6 times to 7 times it being good for the for stock market? It is not. Okay, so when you look at this in isolation, a 6 to 7 cut, okay, in interest rate is definitely not something that you want to welcome if you are an investor in stock market. Okay, you want to look at it and say this is not good. You want to get out before the market tanks. Okay, and like I said, watch out for the second quarter. Okay, all in all, the Dow Jones actually rose by 13.7%, very respectable in a year that most of the attention has been focused on tech stocks. Okay, we have the Magnificent Sevens, and they are all tech stocks. They are the one that is principally responsible for the rally in equity markets last year. Okay, so we have the S&P 500. Now, of course, this is more domestic. Now, the Dow Jones is an index that are watched by international money managers because they become a benchmark to be beat. Okay, do you outperform the Dow Jones or do you underperform against the Dow Jones? So there is a more international index. Okay, it reflects international money flow, okay, capital flow. Whereas the S&P 500 is a more domestic index. Okay, it's more accurate reflection of U.S. investors domestically. So even that has also gone up. It gone up by 24.23%. Okay, and the bulk of it also happens in the end of October all the way to December. Now, last night we have a brand new high, and the market has been flirting with the all-time high, which was last traded on January 4th, 2022. Okay, so that high was never breached last year, but last night it actually took out the high. So that's the reason why the Wall Street Journal declared that we are in a brand new bull market. Is this going to be the case? We'll have to watch. Look at the price. Okay, so this has been led largely by tech stock because those companies that are listed on S&P 500 are also listed on the Nasdaq. Okay, and both mimic each other. Last year, the best performer was, of course, the Nasdaq. The Nasdaq went up by 53.8%. Now, we are talking about the Nasdaq 100 because we don't trade the Nasdaq Composite, okay, which is a broader index. We trade a more narrow index called the Nasdaq 100. And this one has been spectacular. In 1 year, it go up by 50%. This is amazing. It has been going up since the end of October 2022. Okay, and the market has been basically one track. Okay, so last night it will also have a new high in the Nasdaq. May not have a new high. I can't remember we have a new high last night in Nasdaq 100, but basically the trajectory is very clear. Market is going up. Okay, and a lot of that has to do with NVIDIA as well as TSMC. TSMC actually outperformed yesterday. They're also listed in New York. So we can see that was the one news that caused the market to rally in the face of very little information last night. Of course, yesterday we have the release of the Michigan Consumer Sentiment Index, which actually went up. Okay, so that may be the catalyst plus the performance, the earning reports by TSMC and NVIDIA. Okay, so NVIDIA is the new darling. Okay, Tesla is not, but NVIDIA is the new darling. So we can see these companies that has been basically holding up the market. NVIDIA went up 240% last year. Okay, this is at to the end of 2023. And Tesla has done well, but obviously it is not the top performer. Meta, which is Facebook, has also done very, very well. So we can see that most of the concentration has been on these 7 stocks. Okay, and it is lopsided because they only account for, imagine in the S&P 500, there are 500 component stocks and only 7 of them are leading the charge. It means to say that the market do not have the breadth, okay, to continue maintaining the momentum. Okay, so in order for the market to go even higher, we need the rest to catch up. We need to say you need a broader base rally. Okay, if the most of the component stocks are doing well, then obviously it will be very supportive for higher gain forward. But if all the concentration of these gains are on this 7 stock alone, at some point somebody will take profit. Okay, and if if it's accompanied by slightly negative news, then everything will fall apart. For example, Apple have been hit with negative news of late. Okay, so we can see that the share prices has come down rather aggressively from the top, right? So that is also going to be something that you want to consider. Okay, if you are into equity markets. If you have any question, do pop into the question again. So this is the latest interest rates from the beginning of 2022. We can see interest rate has been rising and it has picked up at 5.5%. So this is where we are right now. For the last 6 months or so, interest rate has basically held, okay, they have been treading water. So the market always goes into this. The market will see interest rate rise and then it holds. During this period when the interest rate holds, historically speaking, equity market seems to do well. The moment it starts to go down in terms of interest rate going down, that is where the trouble starts. Okay, if you don't believe, go back and take a look at all the historical charts. When you go to let's say you go in Google from the Federal Reserve St. Louis branch, okay, you type in interest rates and recession, you can find that there's one chart that they have that actually shows every time there is an interest rate cut, okay, it is followed by a recession. And I don't think this year will be any different. Okay, so history has told us that something happened, something else may actually develop out of that. So this is where we are right now. Interest rates is highly unlikely to be cut going into the end of this month. So we'll probably will see at 5.5%. Okay, because so many people are talking about interest rate cut and everybody is buying equity because of this narrative. You can see that, just imagine you go and sit in the sampan, and if everybody sit on one side of the boat, it's very easy for the boat, for the sampan to capsize, right? So this is where we are right now. The market right now is so long in equity market. It doesn't take a lot to flip the boat over. Okay, so be very, very, very careful chasing this market ever higher. Okay, so these are the FOMC. So there's no, the conclusion from the last minute of the FOMC, there is no risk of an imminent rate cut. Based on the CPI numbers, based on the PPI numbers, I don't see that happening. Based on the retail sales, I don't see that happening. And rates is going to remain restrictive, meaning to say that we're likely to see 5.5% unchanged going into the next FOMC meeting, which will happen on January the 31st and February the 1st, okay? And rate cuts may be appropriate by the second half of the year, okay? Not the first half, okay? This is always been what they have been telling us. The minutes of the FOMC meeting has been talking about later half of the year rather than the first half of the year. So the market's thinking that the Federal Reserve is wrong and they were likely to move ahead of time, and they are beginning to bet against the Federal Reserve ahead of time. Okay, that's why you can see that equity market has been so strong. So this is something that we have to consider. Now, remember, I talked about last March, we have a banking crisis in which Silicon Valley Bank has gone down, and it also brought down the storage Credit Suisse. Okay, so during that time, they came up with a makeshift solution, and this solution is termed Bank Term Funding Program. Okay, now this is a 1-year program in which the Federal Reserve will lend money to the banks, okay, in exchange for them pledging their holdings of treasury bonds. Okay, those that they bought during the pandemic, which are now all underwater. Okay, they are probably worth no more than 70 cents to the dollar. But the Federal Reserve said, never mind, give me all this, I will value it at $1 at parity. Okay, and I will extend a loan to you. Okay, and this is meant to expire by March of 2011. So that is one of the reasons why I think if the Federal Reserve is going to cut interest rate, the most likely date is March, because in March we have an FOMC meeting, right? So this will end on March the 11th, meaning to say all those banks that have been borrowing against this facility will have to pay back. The interest rate is about 4.9% or 4.79%, something like that, below the 5.5% interest rates, the discount rate. Okay, so this is even cheaper, and so much so the banks are actually gaming this system. Okay, the banks, what they do is that those banks that have excess reserve, means that every single day the bank will have to make sure that they have enough reserve. Okay, if not, then they'll be fine. Okay, so every bank or every financial institution will have to meet the minimum requirement. Anything above that amount, they will want to lend it out. Okay, so when they lend it out, they at least collect some kind of interest overnight. What you call a call market, 24 hours on call. Okay, and these are very, very short-term commitment. For if you are a bank and you cannot meet the minimum, you want to borrow. If you have those treasury bills on hand, they are rated AAA, then of course your counterparty will be more than happy to lend you the money, right? So that has been the what you call the plumbing system. So when the Federal Reserve offered the bank term funding program at a lower interest rates, instead of lending to the peers, they lend it to the Federal Reserve and earn that 4.79%. Okay, because the discount rate, which is the rate the Federal Reserve will usually loan, is at 5.5%. So why would you borrow at higher cost? Okay, you borrow at a lower cost because there's a new facility called the Bank Term Funding Program. So everybody has been borrowing in that facility, but come March the 11th, the window will close. Okay, so this is going to have a material impact on the price of money. Okay, so basically, I think that is something that you want to watch. That happens on March the 11th. So this is the facility. You can see that there was no borrowing, but this one is created out of the blue just to solve the banking crisis because depositors want their money back and the bank say, I don't have money. And in order to raise the money, I have to sell my holdings of treasuries. Now, the treasuries are okay if you hold them to maturity, but if you're forced to sell because your depositor want the money now, then you have to sell your assets, right? And when you sell assets, you cut loss. When you cut loss, it will have a knock-on effect. Okay, that is the reason why the banks are falling like flies back in March of last year. And I think this problem has not been solved. And we still see a lot of banks are still struggling. Now, if they withdraw this facility called the Bank Term Funding Program, the banks is going to go back to square one. The next time depositors come banging on the door and want the money back, they have no money. Because they access this facility, take the money, take the loan from the Federal Reserve and pay their deposit because the depositors are threatening to leave. Okay, either for a bigger bank, which is supposed to be safer, or they feel that the money, they can earn a better yield by parking the money in short-term treasury bills because treasury bills, earlier on, I showed you a chart that is giving them 5%, even now at slightly below 4.0%, about 4.0%, which is still very good returns. And those are guaranteed by Uncle Sam. So instead of putting the money in the bank and then having to worry that the bank tomorrow will not even survive, then you want to put your money in the money markets and earn that what we call safe money. So the banks are fighting the US Treasuries for deposits because now the US Treasury bills offers a very lucrative returns on the yield. Okay, so you can see that this is all coming to a head come March. Now this is interest rate. I mentioned earlier on, this is what I call every time interest rates cut. You can see that going back as far back as 1958, every single time when the US interest rates goes down, is followed by this area where it's shaded in gray. And these areas are the recession. Every single time they cut interest rate, a recession happened. So be careful what you wish for. If you ask the US Federal Reserve to cut rates, right now it's in holding pattern. Holding pattern means equity prices seems to benefit. The moment they cut, shortly thereafter, we will go into a recession. Okay, so if we have the earliest possible window to cut is in March, shortly after March, we will probably see a recession. Okay, and you can see the duration of all the recession. The shortest being the pandemic recession, only 2 months. Okay. And because they actually send out helicopter money, okay? So other than that, all the recession that has happened before 2020, on the average, the last between 8 months to 10 months, okay? On the average, most there are those extreme ones. Back in 2008, it lasts 18 months, okay? So we can see the next recession is going to be deep. There is no such thing as a soft landing. So this is the background. If the Federal Reserve actually cut, soon after that, prepare for a landing. I mean, a hard landing, okay? All right, now I finished all the basic data I want to share with you as far as the US economy is concerned. I hope that has given you a very good idea where this thing is heading, okay? Once you can understand how interest rate is going to move, it will give you a very big clue as to where the different asset class is going to move, okay? how it's going to impact the dollar, how it's going to impact equity markets, and all the other commodities, okay, and everything in between. So this is the daily time frame. I'm going to show you daily time frame alone, but I don't want to show you something that's too far back. Okay, so we can see that equity markets bottomed out in September 2022, and it has been on the way up. Okay, and this is up to this morning. Okay, so new high traded in the S&P 500. The market has been very hesitant to take out this high, but eventually it took out a high. So last time we have a brand new high in the S&P 500. Short term, I think the momentum will carry it forward. Okay, I have a target about 4,950 thereabout. It is not exact science, but I think there is an equality move here from the low here in December 2022. If I take this equality move here, it will target 4,950. Okay, to be exact, 4,947.84 will be the exact number. But again, like I say, this is not exact science. So take it with a pinch of salt. It gives you a target, meaning to say that if you want to buy now, okay, don't believe that it's going to run away. Okay, there is a relationship here that may actually keep the market around 4,950. Okay, so this is my take. If the market pulls back, the immediate area where the support lies in all these bracket of prices. I've marked them out so that I know in advance in the market do pull back, where are the levels in which buyers may actually emerge. If it fail to hold, then of course failing one is fine, but failing too many is a sign that the market is weak. So be careful chasing this market. There may be some short-term advantage in chasing this market higher. Okay, you can see that I'm actually long. Okay, but I was long last week, this week. So you can see that I'm basically going for one marginal high, okay? And hopefully it can go to the target price, okay? So this is where I am. So in the Dow Jones Industrial Average, I did not buy because this market has been, okay, this is something very, very interesting. But earlier on, I did mention the Dow Jones is an international index. It is a more accurate reflection of international capital flow. When you look at what happened in Ukraine, we all know that the war in Ukraine is in the 700 days. We are almost into the second anniversary come next month, right? So we can see this war is unlikely to slow down. Okay, we have read how UK is actually giving Ukraine more aids in terms of military aids, as well as stationing troops in Poland. There is going to be a massive military exercise, okay, in the Baltic, from all the way from Poland to Finland to Sweden, okay. So it is a massive a military operation that's going to last from now until April. So do note that all pretext of war happens as a military exercise. Before Russia moved their forces into Ukraine, they call it a military exercise. It's the same thing, right? So there is the risk that this war is going to get worse and it's going to spread, okay? If the NATO members are involved, that means it's not just simple a war between US and Ukraine. It's going to be Russia against the whole of NATO. And this could seriously change the dynamic. Now, if you are based in Europe, we don't have to look very far. If you are a German company or if you are a German bank, okay, and this war is having a negative impact on the economy, would you not, as a measure of safety consideration, park your assets away from the area where it is where there is geopolitical tension? I know I would, right? If there's going to be any kind of tension, first thing I want to do is I want to move my liquid assets. So it's logical for this asset to move to the only place of safety, okay, which is not involved in the war, okay, and that can only be United States. So we can see that in the initial part of the war itself, we can see the market actually reacted, but shortly thereafter, we can see there's we have a cross-Atlantic movements of capital into the United States, and if capital move into the United States, they are not going to stay in the banking system, okay? They are definitely going to be deployed into the equity markets. And one way to look at it is from this index, because the Dow Jones Industrial Average only have 30 component stocks, and these are the bluest of blue chip. If I am going to park my money elsewhere for safety, I want to park it in a very safe place, okay? And because the Dow Jones Industrial Average is the bluest of blue chip, it is logical for them to park the money into component stocks of this index. So look at how the index perform. So if there is going to be more tension, okay, more capital is going to move to the United States. Now we have Israel having a problem in the Middle East, right? And instead of just an operation against the Palestinian on the Gaza Strip, it's expanding. The north is to the north, we have Hezbollah based in Lebanon. They have been on practically every day. They are bombardment across the borders, okay? And US, the Israeli IDF Air Forces has actually went in to bomb locations within Lebanon. So this war is expanding, okay? And now we have Iran basically attacking military bases in Iraq and Syria. And those military installations are the American installation, okay? And this means this war is spreading, okay? More and more actors are getting involved in this fight. It's beyond the Gaza Strip now, okay? So if that's the case, if your money, if you are somebody from that region, if you are an Israeli company and your country now is at war, what will you do with your liquid asset? You will move, okay? You will move and park them somewhere else where you think is safe, and that money is most likely going to come into this index here in the Dow Jones Industrial. So this is the bullish consideration as far as I can see. This geopolitical tension is going to lead to migration of capital into the United States, okay? Right, okay, and Nasdaq 100, this one is the killer last year, and I think it will be continue to be a killer. Like, yeah, last time you not only have a new high, it actually traded massively higher, okay? So we can see that the Nasdaq right now is at 17,340, okay? And the target is at 18,600. If based on this projection, okay, I have a tentative target. In fact, it has already hit target lah, okay? This is the bare minimum target. 17,300 is the bare minimum target, which it already hit, okay? So if you continue to punch higher and close higher, I could only deduce that the logical target next is going to be at 18,600. Okay, but however, if the market stop here, okay, I won't be surprised as well because it has hit its primary target, a minimum target. Okay, so again, we want to watch how this thing short term. I think this market will have enough momentum to trade in the same direction unless something else happens. Okay, something not directly involved with stock market happens and which cause a change in sentiment. If we have over the weekend something that is not expected happen, okay, then it will be a negative. Okay. Now, state of the global economy. When we look at US, of course, US is a very logical place to look for direction, right? But US is not operating in a vacuum. They will have to interact with the rest of the world. The rest of the world refers to the G7 economy. People, countries like Japan, countries like the Germans, the Italians, the French. These people are also very important. Their state of the economy is also going to be important. So I have a chart for you. Okay. Now this chart doesn't tell us in one glance what it's all about. Here I have the G7. Okay. They are all listed here, including China. China obviously is not G7, but China is the second largest economy. So I could put that into the consideration here. We can see that US is this one, okay? This one is leading the markets, okay? So this one in UK started off very well in Q1 of 2022. By the end of Q3 of last year, you can see that UK economy has shrunk to just 0.3. So on a comparative basis, from the beginning of this chart here to the latest reading, you can see that it has shrunk to almost nothing. So the UK economy is definitely looking really, really dicey. Okay, whereas the US started at 3.6, it ends up at 2.9, which is not too bad. Okay, on the annual growth basis, I know Q4 was a blown out a number, but the expectation for Q4 is going to be 1.8. So I think it's going to bring down the overall average here. So if the US on an annualized basis is up 2.9%, it is very respectable because it didn't move very much from the start of this period here, which is first quarter of 2022, right? So when you look at individual countries, okay, this brown one is obviously Germany, started beginning of 2022 at 4%. By the third quarter of last year, is down negative 0.4. So Germany is definitely in trouble. Okay. The one in orange is China. China's, okay, I shouldn't have the latest reading here. I don't know what's this number here, but it looks like it's 4.5. Okay, but by the end of Q3 last year, it's actually doing better than at the start of 2022. So on China, all this talk about China economy imploding, deflation going down, that is showing up in the equity markets, but it's not in the real economy. So when you measure the GDP numbers, China did not do too badly. Okay. Yes, it is definitely not doing very, very well, but it is not doing too bad, okay, on a comparative basis. Now, when you look at all this, you can get a sense of where the other growth engine is going to be. Now, this chart is a lot better. Okay, when I compare US to Australasia, okay, I compare US GDP to Japan and Australia. Now, Japan is very interesting. It actually picked up in the first quarter of this year, but it has since slowed down. Okay, so Japanese economy has somehow lost the momentum, whereas Australia is flattish. The one that is actually doing well is the US economy on an annualized basis, 2.9%. So US is doing okay, okay, but Australia is just treading water. Japan is looking to be quite bad because when we look at the Q1 and the Q3 number, okay, it shows a dip in the performance of the GDP. When we compare US and Canada, which is their immediate neighbor, Canada is doing a lousy job, okay? US is maintained at 2.9, Canada's GDP at the end of Q3 on an annualized basis hardly grow because it has been on the down track, okay, consistently since the second quarter of last year. So when you compare that to, let's say, the other European countries, okay, the most glaring one is the one that go negative, which is Germany, okay? Germany is doing really bad, okay? It's really, really hurting. And those that are not in Germany's, they are within the vicinity of Germany's performance, just barely above the 0% mark, okay? So the whole of Europe is in trouble. So if we talk about a recession happening in Europe and then slowly migrating into the United States, can it happen? Yes, it can. Okay, so especially now that the war in Ukraine does not look like it's going to end anytime soon. Now that UK is coming out and say that I'm going to support Ukraine for the next 10 years. Okay, they make a commitment that they'll be there for them. They're going to build up repair facilities. They're going to send troops to nearby Poland. This is all not good development as far as the war is concerned. It's meaning to say the war is likely to extend further. Okay, so if war are by nature inflationary, by the way. Okay, so if this war drags, inflation will not be defeated in any meaningful way. Okay, so be prepared for years of high prices ahead. So this is comparing China and US. China just reported their Q4 GDP. US will report next week. We do not know what's the number, but on an annualized basis, it's 5.2%. This is doing good. Okay, the target was 5.5%. Yes, it did not quite hit the target, but 5.2%, considering the rest are doing just barely above zero. It is a stellar performance. Okay, so in the real economy, the Chinese economy is not doing too badly. Okay, yes, if the trajectory in the US economy continue, it is still underperforming the Chinese economy on a percentage basis. Okay, so this is how we're going to look at the global economy. China may still be the engine of growth because Europe is kaput, Australia is barely alive. Okay, Japan is slowly losing momentum. So that leaves only these two giants. Okay, United States and China. So if both of them stay positive, well and good. But if the US economy goes into a recession, that is bad news. Okay. So in terms of the overall performance in equity market, this is up to the end of last year. Okay, we already knew what happened, right? Now last year, the Indian stock market has been doing very well, up almost 19%. But the beginning of this year, we can see that this week the bank stocks has dragged down the Sensex as well as the Nifty. So we can see that India is a reflection of the banking problem that has surfaced in India and is likely to spread. Okay, so when you look at all the banks, okay, it is a symptom of how things are doing not that great. Okay, with high interest rates, you think the banks will be hoping for higher interest rates. They are not. Okay, because the borrowing cost has all gone up. So this is up to end of last year. So I have not given you the latest. Later on, I will show you some of the chart for the latest, but I'm not going to show you all of them. Okay. So last year, Hong Kong did the worst, and it is still the worst. Okay. But I can sense it's about to bottom. Okay, based on technical consideration. Okay. China, of course, is not doing well. KLCI is not doing well. So is Singapore. Singapore is barely alive. Okay, Singapore market has been in consolidation for years now. Okay, so by and large, it is not extreme. It just managed to hang on for dear life. Okay, the one that did very well was the Nasdaq 100, right? Nasdaq Composite also did very well. Okay, so you can see overall US economy do very well. The weakest link appears to be the Dow Jones last year. Okay, but this is about to change. If all this migration of capital across the Atlantic flows into the US, I think this index is going to benefit tremendously. Now we go into the chart itself. Okay, keep your question coming because I'm looking at your chat, see if I can pick up any question from you. Okay, the DAX is of course the German index. Now, despite the poor performance in the German economy in terms of the data, we can see that equity markets is still doing relatively well. Okay, so we can see that as of this week, as of yesterday's trading, we can see that the market has a very minor three-wave pullback, right? From the top here at 17,000, drop down to 16,342. We have a very shallow pullback. Okay, so where will it go from here? Odds is that it will continue to trade higher despite the poor performance in the real economy. So the equity markets is not a true measurement of the economy itself. People say that when you look at the economy doing well, stock market will boom. But right now we know that the German economy has gone, the GDP is the first major economy to go into negative territory. Okay, it is already in recession, yet the stock market is doing very well. Okay, so sometimes you cannot just assume that because the real economy has tanked, therefore the equity market should also follow. Eventually it will, but right now, based on what we can see in the chart, it's just simply not happening. So I won't be surprised the market take out the 17,003 high towards the 17,800, just based on purely technical consideration. If there's going to be a pullback, the first layer of support is probably going to be lying around just under the 16,000 levels. Okay, so by and large, this market, purely technical consideration is very bullish, but because the underlying fundamentals are all wrong, so if the market ever moves down, we have to take a cue from the US equity market. If the US equity market start to go down, okay, the one that has benefited to the upside, even on very poor fundamental, will be the hardest hit, in my opinion. Okay, because it's not supported by fundamentals, right? So that will be a consideration. Now, the Japanese market is at a 34-year high, okay? And this has only got to do with whether or not the Bank of Japan is going to normalize interest rates, okay? There was a period of time the market actually was in consolidation. That period was actually in late last year, where there were talks about Bank of Japan trying to hike interest rates. And if that is the case, of course, high interest means the cost of capital has gone up. Now, the Japanese yen is a victim of all this move because the Bank of Japan has deliberately kept Japanese interest rate at negative 0.1 when the world has actually high interest rate non-stop for 18 months. The Japanese interest rate remains steadfast at negative 0.1. So it became a favorite funding currency. People will borrow in Japanese yen. It has two advantages in borrowing Japanese yen. Okay, you borrow in Japanese yen because interest rate is next to nothing, right? And then you have the added advantage of a foreign exchange gain because the yen is falling because of the interest rate differential between the yen deposit and, let's say, the US deposits. Okay, negative 0.1 against positive 5.5. So obviously the differential between the interest rate will favor the dollar relative to the yen. So the yen comes down. So any talks about the Bank of Japan hiking interest rate to normalize interest rate, even back to zero, okay, will cause an wholesale unwinding of this carry trade. People who borrow in Japanese yen will find that it's become less advantageous to continue to borrow Japanese yen because interest rates are going up. You want to retire that loan, meaning to say that you will sell off whatever assets you have. Because one of the beneficiary of very deep discount in interest rate is that the money goes into Japanese equity markets. Okay, and if people start to worry about Bank of Japan normalizing interest rate, what they will do is they will unwind their whatever this money has been employed into, basically into equity market. They will release this position, meaning to sell out, take the money, pay back whatever loans that they have in Japanese yen, and that will be the logical thing to do. So any kind of talks about the Bank of Japan normalizing interest rate by hiking interest rate even to zero, okay, it is going to be a negative for the Nikkei 225. Okay, so it did not happen. So there is less and less talk because inflation is coming down. Because the Bank of Japan is looking at inflation numbers. And of the last 2 months, inflation numbers seems to have cooled off a little bit. So they take away the incentive to hike rates, okay? And they are aware. So look out for interest rates direction, okay? So if this momentum continues unabated, the next target, okay, is likely to be 38,770, just purely based on technical, okay? Right, Hang Seng has been falling and falling and falling, okay? It has been falling for ages. So you can see that the Hang Seng market has fallen the whole of last year, and then this year we are only in the 3 weeks of 2024 and it's still falling, okay? And the low traded on Wednesday was 15,119, and this market is getting very close into a bracket of price because this is from here that the market actually ran up from just above 14,500. It went up all the way to 22,700. So you can see this is a massive run up. So this pullback here, okay, as consistent as it is, there is no sharp move. Okay, sharp move means on the reverse side, if you've got a very big move like this, but if it's on this side, okay, very, very sharp move, then it will be very serious. The market has come down in a very measured way, in my opinion, on a relative basis. I think it's getting very attractive to go counter trend as far as the Hang Seng is concerned, okay? And China just report their Q4 GDP, 5.2%, and the world say it's bad. How can it be bad? It's actually good. At least it wasn't as bad as some horrible number. 5.2% in Q4 is a fantastic number, all things considered. So eventually, I think the buyers will come back. Now, this month, I think the China government agency has actually released the what I call foreign direct investment, the FDI, into China. For all these talks about China imploding, companies are investing heavily into China. If you look at those numbers, go and Google FDI China, okay? You will notice that the latest number reported are superlative because foreign companies are moving back into China. All these talks about de-risking, decoupling, the companies are not taking the narrative, okay? Follow the data set, okay? So all things considered, I think the market has dropped quite severe enough, at least for a short-term bound. Okay, so I think that it's going to be likely to be a short-term bound happening very, very soon in the Hang Seng. Okay, perhaps to tie in with the Chinese New Year. Okay, so I do not have the chart in that format, okay, because those are taken from MT4, MT5, right? So I don't have those charts on my MT4, MT5. So what I did was I go to investing.com and I get the data set and plot a chart for you, okay? So this is based on closing price for the KLCI going back to 2020, okay? So this on a weekly basis, you can see that it has come down, okay? But it has not collapsed. So actually the market actually found a bottom somewhere in the middle of last year. So KLCI had actually bottomed, but you can see the overall rise is a three wave. Now three wave is not a very strong sentiment, okay? Three wave is technically a corrective bounce. So unless a market can seriously trade above 1500, okay, then maybe we are into something else. But if the market is only doing a three-way and it start to lose momentum to the upside, I think it is probably going to come down again, okay? But by and large, it is not really that bad, okay? Although last year it did globally, it did not do very well. But by and large, I think the sentiment since the new government is in place, I think it has been positive overall. So this is the daily time frame. Again, from data set from the investing.com, I get a three wave in the daily time frame. Market picks out this week at 1503. Okay, and over the last 3-4 trading days, it has been trading downwards, and it is quite understandable because the market is just barely above the previous swing high here. This swing high was actually traded at the beginning of the year. Okay, beginning of last year, you can see the market only achieved a marginal high before it comes back down. So this is not a good development, technically speaking, because it's three wave for one, and the market fails to sustain above the previous swing high. So I would think, generally speaking, the bias is probably to the downside. Okay, although there's possibility of a continuation of this pattern, meaning to say it will not be a simple three wave, it could be something more complex. Can it be a double tree? Yes, it could be a double tree. Meaning to say the market will grind higher, okay, but it won't surge in any major way. So by and large, I do see this as finishing its rebound and getting ready to come back down again. So all you need to do is just draw a simple support line, joining all the most important low that we have seen so far last year on the daily time frame. And then if the market closed below that, that will be the signal to go short. Okay, but by and large, that will be a simple way to look at it. In Singapore, also the same data set, I got it from www.investing.com. This is a weekly time frame. You can see that Singapore market has been flat. So if you have no reason to be in the Singapore market, take your money and deploy that somewhere else because it's totally dead. Okay, it's not going down, it's not going up. Earlier on, I did show you that it's down 0.3% whole of 2023. So it's really not going anywhere. So if you have a choice to get out of Singapore market, maybe you should. Okay, on the daily time frame, you can see the market is basically all in three wave. Down three wave, up three wave, down three wave, up three wave. So the market is in a corrective consolidation phase, which is lasting more than a year now. Okay, so we can see that it is not going to go anywhere. It has just finished a three-way bounce, and it's coming back down again. And the pullback has been three-way as well. So again, I wouldn't want to waste time in the Singapore equity markets if this is the condition that you have to operate under. Okay. Okay, foreign exchange. I know my timing is, wow, I have been talking about this for quite some time now. Okay, Nan. Foreign exchange. Let's see what is the implication for dollar. So euro versus the dollar. I don't have the dollar index here, but I do give you the major pairs. So we can see the euro has actually benefited somewhere about the same time as equity market in the States actually bottoms out. So it is a beneficiary of the stock market rally because the dollar has been coming down during this period of time. And we can see that in this market here, we can see the top side is 112.75. And the market is doing possibly a larger degree three wave. So if this is a larger degree three wave, we could possibly see euro dollar going back to about 103 to as low as 101. That will be the larger time frame. Okay. Internally, I think the market hit a high at the end of last year at 111.39. And it's probably coming down in a three wave, a very, very small degree three wave, targeting anywhere between 107 to 106 half. So in the market ever bounce, okay, look out for a bounce into about 110 and then prepare to go short for a move backwards in the three wave equality move, targeting 107 at the minimum. Okay, so this could be the game plan if you are into currencies. Okay, so my outlook is at a bounce followed by a pullback, at least for the medium term. Okay, so in the sterling itself, sterling, you notice I've gone long, right? So I've actually seen this as a larger degree of rally. A target ideally should be at 133.75. However, I'm just going to be very cautious in this because internal structure suggests that there is a minor three wave here. You can see there's a minor three wave here. And if this is three wave, then it's not going to go so high up. Probably a 128, okay, or even 127, just under 128, okay? So I'm going to go for this, hoping the market will pull back, give me another chance. And then along the way, I will basically be trading looking to trade to the upside, okay? But internally, maybe I'll look for levels to get in and get out, okay? So right now, I'm already long, and I'm hoping the market can go up and test maybe the 120, 128, 127 levels, okay? Then if I hit my target, I will come back and wait for a pullback. And if the pullback makes sense, I will again go back and buy this sterling. Now, this is despite the fact that UK economy is not doing well. Got nothing to do with it, okay? Everything is going to be on interest rates. What the Federal Reserve will do, because it will directly be linked to dollar, okay? Not just the strength of the sterling pound. So in the Aussie dollars, it's the same thing. Aussie dollar is more flattish. The market has been trading between 0.6260 to 0.69. So within this bracket of prices, the market, by and large, for the last 6 months has been trading within this bracket of prices. Higher to sell, lower to buy. Okay, so right now I have no position, but the market seems to be wanting to bounce. If the market bounce, it will create a three-wave pullback, ideally targeting the 0.63 half levels. So again, short term, maybe to look for levels to sell for a dip into this lower end of the bracket, which is, we can see that this consolidation is actually quite clear. Okay, Even at a lower point is 0.6170. Okay, so the downside risk is actually quite little. Okay, means that if you can buy as close as you can to the bottom of this range, okay, I think it's quite advantageous. Okay, and over in dollar yen, now dollar yen actually peaks at 152, just under 150, 151.90. Now you notice that this high here corresponds with this high over here. 151.94 was a high in 1922, no, 2022. Okay, and the market was actually came under intervention by the Bank of Japan. Okay, that caused initial slide. Okay, because if the yen remains too weak, now remember Japan imports everything, okay, in terms of energy. They don't produce any energy. They have some nuclear power plant, okay, and we know at the beginning of the year another one was damaged on the eastern coast of Japan. Okay, so other than nuclear power, they have no other generic production of energy. They have to import in all their energy needs, and a weaker yen means they're going to spend a disproportionate amount of yen to secure energy supply. So a weaker yen is not ideal, okay, from the manufacturing perspective, because it pushed up their input costs, right? So 152 was where I think the market was hoping, was watching, and the Bank of Japan actually came in to intervene. That was back in 2022. Okay, the market eventually went down after the intervention happens. You can see this big move here. There is that intervention move. Okay, then after that, the market does the work for them. Dollar yen bottoms out at 127.20, and it has never looked back. Okay, the whole of last year is basically one track, all the way back to this near this level, because the talk then was that the Bank of Japan may be looking to intervene. And we have a lot of commentaries by officials in Japan saying that they are looking at the rates on a daily basis. So they give currency speculators a notion that the Bank of Japan may intervene. So the market decided it's no longer safe to continue to hold long position. So decided to take profit, and then it caused a snowball effect. Prices went up to as low 140.24. And then bounce back up again over the last month or so. So we can see that prices on Friday pick up at 148.80. Okay, is this the end of the move? I think possibly, if not already pick out, the peak is nearby, because I think anywhere between 148.87 to 147.70, 149.70 is going to be an area of selling opportunity. Market may have already picked for all I know, because this market here ends as a shooting star here. Okay, so there's a possibility market will pull back, but by and large, unless the Bank of Japan actually normalize interest rate, there is a risk that the market may go even higher after this pullback. So a lot will depend on what the Bank of Japan actually do. If they do nothing, the speculators are going to come back and buy dollar against the yen, take it even higher. Okay, so we'll have to watch. But for now, it looks like it's going to be a good sell levels, at least targeting 144.60. Okay. Dollar Canadian is also sideways more or less. You can see that the whole of later half of 2022 all the way until last year, you can see that the market is operating within this band of prices, anywhere between 130.90 to 140. So between a 1,000 point range, the market has been doing sideways. Okay, so right now the market is in the middle of nowhere. So is there going to be a low risk trade? You got to go down to a lower time frame, because on the day time frame there is no low risk trading opportunity. Okay, so even if the market goes up to 137, it's still not a low risk. You want to sell near the upper band of the price range and buy near the lower band of the price range. Okay, and if I'm going to say a low, I'm thinking a low about just under 130. A high of 140. So between this 1,000 point range, buy as low as you can closer to 130, and sell as close as you can to near 140. That will be the overall game plan. In between, the market just going to do sideways pattern. Okay. So for currency performance, we can see that the whole of last year, okay, only two currency pairs actually in the negative, as far as we can see, dollar Sing and dollar Canadian. Okay, so last year dollar did not do well. On a year-on-year basis, dollar actually closed almost unchanged if you look at the dollar index. But on the that means it is a positive for all the other currencies. The one, of course, that did the best was actually dollar yen. Okay, so dollar yen did very well last year because of interest rate differential. This is logical. Okay, Aussie ended the year almost unchanged. Okay, sterling did well. So does euro dollars. Okay. Now the other minor currencies, we can see that the Sing versus the ringgit. Okay. Sing dollars has done very well relative to the ringgit. Okay. And that has been the case. I think it will still remain the case for time being. Dollar versus ringgit is also doing very well last year. 4.3% is considered very, very good. Okay. The one that didn't do well was dollar versus the Sing. But Sing on a relative basis is still relatively stable. Okay. So look out. Right now, when the war breaks out in Europe and now in the Middle East, the one currency that I did not show here is actually dollar Swiss. Okay, Swiss franc actually did very well. If you have to choose between strong currency to park your money, okay, instead of moving your money across the Atlantic into the United States, let's say within Europe, you have to pick one place to park your money, you most likely will put your money in Switzerland. And it means having to buy Swiss franc. So Swiss franc could be one of those currencies. Singapore dollar has also played the same role in Asia. So Singapore dollars has been relatively stable, okay, although it dipped against the US dollar by 1.5%, but it's not too big a move here. So it's relatively stable. So Singapore dollars is performing the same function as the Swiss franc to some degree. Commodities, again, I'm not going to cover all the grains and all the other stuff. I'm going to just concentrate on oil and gold, okay? So in oil, now, oil market actually peaks out at $97.90 and it has been falling since. And this was in the third quarter of last 2022, right? So the oil prices has gone down, gone back up, and it has been sliding again. So lately, it has stabilized near the $67.70 level. Okay. Now on the end here, we need to know two major factors. When you trade oil, you got to know what OPEC Plus is doing. Now, OPEC Plus is no longer as dominant, as influential as they used to be, but they are still a major player, right? So they have been cutting production, okay? First, they thought they will hold a production cut all the way until the end of 2023. But now they extend that production cut all the way to end of 2024. So in terms of supply, there will be lesser supply in the market, okay? But the US has actually filled up the vacuum. Now, US has been pumping something more than 7 million barrels a day, okay, to fill in the deficit left behind by the OPEC Plus. So it more or less neutralizes prices. So you can see that despite OPEC Plus cutting production, oil prices did not rally. Okay, and on the other hand, it does make sense for the US to produce more because they need to replenish their strategic petroleum reserve, which Biden actually draws on. Okay, which was not meant for this purpose, but they actually draw down the petroleum reserve to fight inflation. Okay, because like I said, gasoline is something that the typical Americans needs because they need to drive, right? So gasoline prices is very sensitive, especially now going into an election year. So if the cost of living goes up, the voters are not going to be happy and they may not give him the vote. So he makes sure that things remain affordable. And the most important thing that's affordable is his gasoline prices. So they need to keep gasoline prices under wrap. So that has caused them to produce more, okay, to offset the cut in production. But by and large, in the meantime, the low at $67.69 seems to be the bottom for now. And if this retrace in the three-way, which is a very normal relationship, it could target $77.40. Okay, I was hoping the market will go up to $79. Okay, you notice I actually went long too early. Okay, but I went long again at $71. I put my stop just below this most recent swing low here, and I'm hoping that we will do a three-way for me to get out of both position away alive. Okay, so basically buying crude oil is actually the more sensible thing to do, because when you look at the geopolitical situation, whether in Europe or whether in the Middle East, energy prices, especially right now of all this conflict in the Red Sea, okay, and that Red Sea is a major conduit, okay, linking to the Suez Canal. A lot of traffic move up and down this waterway, okay? Now the cost of everything has increased tremendously because all the vessels, the cargoes, and the tankers will have to make a roundabout trip round to the Cape of Hope, okay, around before they can deliver to Europe. So this is increasing production costs and freight charges and insurance. So it basically costs more. So inflation is not going to go away anytime soon, okay? So that means to say that buying oil is a safer bet than selling, okay? If I don't sell anything above $90, I cannot be selling at below $80, okay? So basically, doing the counter trend seems to be the thing to do. So I've actually gone in on that belief. But however, the price did not hold at $76. It went down to $70 and even below that. Okay. But by and large, you can see that this is working out to be a three-way bounce. Hopefully, it will be able to go up to $77 and a little bit more for me to get up. Okay. And over in gold market, now the gold market actually have an all-time high traded in November last year. Okay. So you can see the market actually had rose up to $2,144.61. And this is an all-time high. And this high was actually achieved in the early morning, Monday morning in Asia. And when London opened the same day, the market actually sold off. And this sell-off, okay, is possibly not over yet. You can see that the price went up all the way to $1,973 before it bounced. So two possible scenarios. The market will continue to go down in a three-way pullback, targeting $1,920. Okay, so we can see that this is one scenario. The other scenario is that the market finds support around this area of prices between 1,965 to 1,985, which it did first time. The low was 1,972. Okay, 973. So if the market continue to edge lower, it all depends on how the market behaves around these prices. Okay, if it punch through and close below, the next level will be this three-way pullback. Okay, targeting 1,009. It is still lower to buy because the entire trend is bullish. Okay, this is a counter trend. Okay, I think it is basically a bull trap here, trapping those who bought above $2,000, $2,100. Okay, so those people who bought at the high end now are caught. Okay, so once they capitulate, and the market will be ready to rally one more time. I am thinking eventually the gold prices is going to go way, way beyond the $2,144.61. Okay. In silver, silver has been underperforming. You can see silver is more or less sideways. There seems to be demand below $22. So we can see the prices have not been able to rally in any meaningful way, so lower to buy. The same opinion as gold. I think both precious metal are lower to buy candidates. Okay, so far we can see the lowest traded this round was about $20.70. So anywhere between $21.80 to $20.70 lower to buy. Okay, the lower the better. Okay, so long as it doesn't break below $19.80, I think the market is a buy. Okay, eventually it will play catch up. Okay, we will probably see. This is nowhere near the all-time high. Okay, the all-time high I think is about $35. Okay, so we have a long way to go. And overall in commodity last year, stellar performance is this thing called cocoa. No, I know lots of you don't trade soft commodity. Now cocoa has been one of those commodities that outperformed under the radar. Nobody was watching it, and then it surged 62% last year. Okay, so the one that I thought would do well was actually the grain, but the grain didn't do well last year. Okay, so maybe it's all timing. But eventually, I think all these stocks. Now, this couple of weeks, you'll notice that there is a massive protest in Germany. By who? By the farmers. Now, remember not too long ago, those farmers in the Netherlands, in Denmark, okay, they were protesting the same thing. All these talks about going carbon neutral, trying to remove nitrogen from the atmosphere because it contributes to global warming. Okay, so they're thinking that farming and fishing is a crime. So they are trying to eliminate farmland. And that has led to a massive protest by the farmers in Germany. And this will have a long-term consequences. The whole of Europe has gone nuts. Okay, they have this mentality that growing food is anti-climax. Okay, you have to go for the Green New Deal. Okay, basically you got to remove all these toxic gases from the atmosphere so that Earth can breathe. But if the Earth breathes, but the population dies because of starvation, what good does it do, right? So basically, all this will lead to eventually a major food crisis in the years ahead. So you want to stay invested in commodities just for that one reason. Okay, so watch out for commodity prices to move. So cryptocurrency, I'm going to cover just two, okay? Because this year, the whole of last year, in fact, the only talks that matter was cryptocurrency. And we talked about, okay, the ETF, the spot ETF, which was eventually granted, okay? But there was a lot of drama leading into the approval, okay? So we knew that a lot of major traditional Wall Street players are muscling into this space here. Now, ETF is very much like a gold ETF. It's an exchange-traded fund. They don't actually have the product. It's derivative of a derivative, okay? So instead of buying Bitcoin from places like Binance or Coinbase, they say, you don't even have to do that. Okay, come to me. I'm an ETF. Okay, I have a lower trading cost and I'm more liquid. And it shows that there's a lot of institutional money in this. Okay, in the first 48 hours of trading, I think the trading volume is about $3.6 billion worth. Okay, and that's massive. Okay, considering Bitcoin prices didn't go crazy. Okay, it went crazy from almost $50,000 to go down to $40,000. But that is nothing compared to the price movement of any kind of big movements in Bitcoin. And Bitcoin sites are known to travel more wildly than that. So basically, the pullback from 49,000 caused the market to pull back, and it's very much in the manner of the gold market. Market have a high pullback very sharply, and I suspect this pullback is not over. If we get a bounce, I think somewhere we want to see a bounce back to the 50% mark, somewhere around the 45,000 levels. Look out for some kind of weakness going forward, and then look for another leg down to target something like a 36,500. Okay, so I think there's a possibility of three waves. Once this market pulls back, it makes a lot of sense to look out for buying, because the entire trend here is very bullish. Don't care the reason. We look at the chart itself. Technically, it's a buy. Okay, so unless the price breaks below 33,300, it is still a buy for me. Okay, so look at it from this perspective, it's lower to buy. Can you sell? Try not to sell because the market is definitely having a very bullish bias here. Ethereum is the next big thing. After BTC ETF, the next stock is an Ethereum ETF. So will that ever come around? The big boys are also interested. Big boys like the BlackRocks are also very interested to launch a ETF for Ethereum. Now, at the end of the day, I think all these numerous coins will probably be eliminated over time. I think at the end of the day, we probably will have only a handful of digital currencies. Which one will survive, we do not know. Okay, but Ethereum is definitely going to be one of those that survive. XRP may also survive because XRP has real life usage. Okay, banks are using that blockchain to actually to actually launch some of their products. Okay, so some of the major ones will survive, but you know those meme coin, those are the ones that may actually go into oblivion. Okay, be very careful about investing in this because this space is super speculative. Okay, there's no fundamental whatsoever. Okay, so if you buy those very cheap coins, thinking that from a few cents, okay, it can go to $1 and it can become a multi-millionaire, those are the risks you take. Okay, you can, because it can go to zero. So watch out for development. Overall, this Ethereum is still in a major downtrend. This bounce from $1,069 is actually a corrective bounce, and it has already hit target. The minimum target is 2,578. Between this level and 2,829, that is the target. The market went up to a high of 2,716 and start to pull back. So this pullback could be a reflection of a temporary top, okay? Because for all we know, this correction may still have some more legs, okay? But in the meantime, I think the upside risk is actually quite limited. Okay, no, what I mean is that upside potential is actually quite limited. So there's a risk the market may pull back. The nearest area of demand, I think, is about $2,200 and $2,225 to $2,337 thereabout. So okay, very little trading range. So this is a market that you want to sell as market goes higher. Okay, we have overshot our timing. And if you got questions, shoot now or forever be silent. Okay, guys, I'm prepared to take questions.
Any question, you can drop the message in the chat. Any questions? Oh, good.
If you want to hear more tomorrow, on Sunday at 8 p.m., I have a regular weekly market wrap. So if you want to have more, come back tomorrow. Otherwise, I'll see you on Wednesday, because on Tuesday, we're supposed to do a live trading, right? So Tuesday I will not be available because I'm having a presentation somewhere else. So I will see you on Wednesday at 9 p.m. for live trading.
It's Wednesday.
I hope you enjoy it. Thank you very much.
Can I share my screen for a while?
Yes.
Okay, sure. Okay. You guys can scan this QR code. The left-hand side for everything trading Asia support. If you have any questions regarding about the seminar or webinar or a broker's promotion, you can scan from this QR code. And the right-hand side is everything trading Telegram channel. We do have provide a graph, any information about trading, any signal, you can join our channels here. Okay. Okay, all good. Okay, you don't have anything, so I will end the webinar for today. Sure. Okay, thank you for joining our webinar. See you next time.